take your money. In the old days, in the James Bond days, you could go anywhere in the world, and if you have US dollars, they would roll the red carpet out. We want your money, because they know you have money, you know, you can invest in their country. They're basically saying no more, okay? So the disclaimer here is, this is my opinions based on my research. Please do your own due diligence. But by all means, don't just listen to the media, even the governments, and especially the bankers. Any bankers in the audience? By the way, two of my clients are CPAs here in San Jose, and I had them review it, and they said, yes, you can present this without getting in trouble. But I said, do your own homework, please, because you know, these are your assets, this is your life. Protect it. Real briefly, in 2008, because of the crisis, the Federal Reserve Bank, I'll nickname it as the Fed, they basically bailed out the banks because the global financial system would have collapsed. Whether you're conservative, liberal, right wing, left wing, that's pretty much a given. And what most people don't realize is the Federal Reserve Bank is our U.S. central bank, but it is not a federal agency. Okay, it's a private corporation with European and U.S. commercial banks as shareholders. Let me repeat that. The banks in Europe and the United States, the big banks, own the Federal Reserve Bank. So when the Fed bailed out the commercial banks bailed out themselves. Now, who's the Federal Reserve? It's the bank. Guess what? They were taxpayers, us. We bailed out the banks, okay? And it wasn't just a few trillion. Some people, and it's going on now with what they call quantitative easing, QE, where we're buying mortgage-backed securities and U.S. Treasury bonds, $85 billion a month. But back in 2008, 2009 timeframe, some estimates have it as much as 16 trillion was doled out. And one stuck out with me. You know, some banks really needed it, AIG needed it, whatever. But one recipient was a company of two wives of Morgan Stanley executives. They somehow told themselves, we're a bank, so we need the stimulus. These are multimillionaires, okay? So I won't mention their names because I don't want to be on their list. So, in summary, on the bailouts, the Fed bailout is basically what I call TBTF, too big to fail banks. And we were left holding the bag, the taxpayers. So in other words, it was a big Ponzi scheme. The banks bail out themselves. So what I call next is the next financial crisis. I call it 2.0. It's called the bank bail-in. And the reason why is governments pretty much know taxpayers are tapped out. You know, we know we've been robbed, and so that's not going to work anymore. So what they've designed is what they call, a bail-in. And instead of using taxpayer funds in a bail-out, they're going to use creditor funds to bail out the banks. This includes your deposits. Okay, let me repeat that. This is your bank deposits. So what happens is, if the banks do collapse, usually on a Friday, by the way, and then over the weekend, literally the FDIC regulators, they go in and they recapitalize it and they say, well, here are the losses. Then another bank acquires the assets, so they open on a Monday, so there's no panic, right? Because everybody would panic if they say, oh, where's my money? They run to the banks to try to withdraw it, okay? So because of the crisis in 2009, they enacted some laws in 2011. But basically, when you put your money in a bank account, it's no longer yours. Okay, and here's the official reason. It is now on the bank's balance sheet. Any accountants here? Okay. Because if they pay you, even if it's, what do money markets pay now? 0.1%? Okay, whatever interest they pay you, they figure that's capital at risk. It is now an investment. In other words, when you invest in a stock, you can lose all your money, correct, if it goes under. So it's called capital at risk. So the money now becomes the property of the bank. It is not yours. You are now what they call an unsecured creditor. That's a fancy name for you own part of the bank, you're an investor. So the bank collapses, guess what? You're smoked. Okay? So smart people will go, well, what about the FDIC? Anybody familiar with them?
Yep.
They guarantee your funds up to $250,000 per bank. Okay. By the way, anything above that limit, you're kind of stupid because it's going to be gone when they collapse. Okay. Now, even if you're under the limit, you are secure to the extent that the FDIC can cover it, right? Because if I'm going to share your money, I have to have enough collateral and money to back it. So what's the next question? How secure is the FDIC? Okay, in 2009, and this is on their website, the FDIC fund was a negative $8.2 billion. So that insurance that they cover all your deposits, they not only didn't have it, they had less than that. They were in the red. So what they did was, they said, all right, they went to all the member banks and said, go out 5 years, extend it out, bring in all your membership fees, pay in advance to recapitalize the fund. Okay, as of December 2012, they had $33 billion in there. That's a lot of money. Here's the problem. As of last year, there was $8 trillion in deposits, which means for every $100 that they guarantee, only 41 cents covers it. So if you're part of the other $99, you're getting in line. And it's not just what they have today, but by law, and this is on their website, by law, they are only supposed to have 1.15%. So in other words, even the law says $1.15 guarantees $100 in deposits. What happens to the other $99, right? And this is another 10-hour discussion, but it's basically because of the fractional reserve banking system. Do you guys understand how the banking system works?
Yep.
Okay, it's not you lend $1 to the bank, you deposit it, and they lend it out to someone else. And they earn the net interest margin. They pay you 1% or 0.1%. They loan it out at 5%. That's how they make your spread. But it's worse than that, because that dollar they take, they loan it out. This is oversimplification. They loan it out to 20 other people. So you see how they make a lot of money? They're earning 20 times the amount of money. Yeah. Go ahead.
I think that for every dollar that they have, they actually print $9 and they don't $10.
Yeah, it's 10 to 1 leverage. And because of the crisis, by the way, in 2007, the leverage is up to 40 times. And that's why if a couple of people defaulted and had to call on a loan, so they didn't have it. Now, Iceland, do you remember Iceland? That kind of triggered in 2007, 2008. They were leveraged 100 to 1. That's why they blew it first. All right, so, in any case, the whole point of fractional reserve banking is because they don't have as much money as you think they have. That $1 deposit is loaned out to multiple parties, the same dollar. So, what will the crisis, I don't know when it's going to happen, no one does, unless you're God, but pretty much all the experts are saying it will happen. It's just a matter of when, okay? And what will it look like, this financial crisis 2.0? As in 2008, when there's a run on banks, they tend to cascade. In other words, when Lehman Brothers blew up, there's a thing called counterparty risk, meaning if Lehman Brothers owned Morgan Stanley money, because they lend each other money overnight. So Lehman Brothers owed Morgan Stanley, Merrill Lynch, Bank of America, Citigroup. If they couldn't pay, then all the other banks are screwed too. Okay? That's how our banking system works, you guys. I mean, it's nuts, but it's worked for years, right? As long as there's confidence in the system. But since it's fractional, what happens to the other $19 out of the 20? Okay? So instead of a bailout, the bail-in will be implemented, and your deposits, they will target. I don't know when or how before it gets really bad before they do that, but they've already done that in Cyprus. Have you heard about this? They're doing that in Poland. They're going to do that in Italy, and it gets worse because Canada may be more solid than ours, their banking system, because they didn't over-leverage on the real estate stuff. They wrote it into their laws. Australia, New Zealand, the Eurozone, United Kingdom, United States. Okay? It's called the Dodd-Frank. That was the finance reform, which is like thousands of pages. Well, they slid that in. Because they know, they wouldn't write a law, enact it, unless they knew they would have to use it. And so people think Cyprus was an anomaly, it's a one-off thing. That was the template, that's the blueprint. They're just testing out to see what happens. By the way, Cyprus is kind of like the Bahamas of the United States. It's a safe haven island where a lot of Russian, no, I'm not, yeah, the former KGB, like Putin, you know, they're all businessmen, right? And that's where they put their money. So when they got robbed, there were a lot of death threats. The parliamentary. Now, the really rich Russians, they got their money out of there earlier this year through London. So, you know, depends on how big the sharks are, right? It's shark eating sharks at the end of the day. We're the guppies, by the way. You know, anybody play poker? Okay. What's the old saying? When you belly up to the table?
If you can't identify who the fish is, it's you.
Yeah. If you're not the sucker, if you don't know who the sucker is, you're the sucker. Because you're not playing against the house, you're playing against 4 other people. So they're all ganging up on you, right? And you go home drunk because you're at a convention, and at the end of the day, all 4 are dividing up your money. So if you don't know who the sucker are, you're the sucker. Okay? We're the guppies. So now, not only will taxpayers and governments will be spared because, well, they're not going to go after taxpayers anymore, right? We're tapped out. But the deposits, pensions, and insurance funds will also be raided. Why is that? Because under the Bankruptcy Reform Act of 2005, credit derivatives holders have the highest priority. You guys know what credit derivatives are? Warren Buffett called it the financial weapons of mass destruction.
Yeah.
It's what caused the 2008 meltdown. Because you're borrowing, you're using leverage. You're using leverage on top of leverage. If you understand calculus in first and second order, you understand what it's deadly. Okay? And the world GDP is $60 trillion, I think, 60, 70. The notional value of derivatives is 1.2 quadrillion. That's 3, 6, 9, that's 15 zeros, or 18. Can't count that far. Not a calculator. Okay, that's a lot of zeros. Okay, so it's called leverage. It's like me putting down 1% of the house and borrowing 99%, right?
Without a job.
Yeah. By the way, which happened in 2005, 2006, right? The liar loans. Okay. So that's a simplified definition of leverage when you overborrow from where you can't service the debt relative to your income, which may be zero if you don't have a job. So in the event of a recapitalization or bankruptcy, derivatives are the highest priority. They get paid off first. Because guess what? They're all banks. They're going to take care of each other.
Take care of themselves.
There you go. The lowest are the shareholders, right? People that own the stock is Citicorp. Just above that are us, the depositors. So if you're one of the 99, get in line. When it comes down to get paid, you might get, anywhere from 10% to, if you're lucky, 90%. You're going to take a haircut, in other words. Okay, so the bank. How much time do I have? Am I okay? Okay. The bail-in laws are already in place, and anybody heard of the BIS, the Bank of International Settlements? You've heard of the Fed, you've heard of the European Central Bank, you've heard of the Bank of Japan, the Bank of China, the Bank of England. They're all central banks for their respective sovereign countries. The BIS is a central bank of central banks, meaning they're the ones that wrote these laws. Okay, so it's in place. This is not me. And I have links, by the way, from Huffington Post, in case you think I'm a little more conservative. It doesn't matter, right? I have links that I can provide you where you can do your own research, okay? There's videos and stuff too. So anyways, the BIS, the central bank of central banks, they pretty much set policy that all the other countries fall in line. I mentioned Cyprus, it's already happened. It's happening in a couple European countries. I mentioned the other countries. And the bottom line is, the technical term is, there's systemic risk, and it's pronounced because the banks lend to each other. If you're familiar with the LIBOR, the London Interbank Overnight Rate, they set interest rates for the whole world, and they lend money to each other. So they literally park their money overnight, and they pay a little bit. So everybody lends to each other, okay? We're all interconnected. It's like me and all of you, we're all bankers, and I owe you dollars, you owe him $1, and so on. Okay, so if one person goes down, everybody gets infected, okay? They can cause stability. I would disagree. It actually destabilizes the system. And the reason why I said investments, pensions, and insurance accounts are at risk is because the pension funds, CalPERS, any teachers here, they park their money in these too big to fail banks as well. So do insurance carriers. And by the way, insurance carriers are more solvent than banks generally because they're not as leveraged. Any insurance salesmen here?
We're not supposed to say yes.
Oh, sorry. Well,
Yes, there are some.
you can sell to your clients this. Insurance companies are actually more solvent because they're forbidden by the states to lever up. You know how you take a $1 deposit, you lend it out to a bunch of people. They can't really do that. They're limited. So, but they do invest and park their money in banks, and they also buy the bank debt. So the bank goes under, they're exposed. Okay? States and local governments, do you think they deposit more than $250,000?
Sure.
Absolutely. Where do you think they park their money? JP Morgan, Goldman Sachs, whoever, Morgan Stanley. So we're talking about tens of trillions of dollars could dissipate in the event of a systemic banking crisis. So what should you do? This is my one slide. Hope and pray I'm wrong. I could be wrong. Okay. I don't think I will be, but I could be. Realize that all your accounts are at risk in the event of a bail-in. Explore custody arrangements. Real quickly, without being salesy, the custody is this. I just dropped off my car last Thursday, and I picked it up, I think, Tuesday. Okay. In a bank, remember I said when you deposit your money, it's no longer yours, the bank owns it, it's on the balance sheet? Well, when you drop off your car, ownership never gets transferred. You still own it. So if this car shop goes out of business overnight, and they recapitalize all the creditors, they can't sell the car. It's still yours. So you're just temporarily safeguarding it, storing it with them, but you still own it. Okay. So you want to explore something like that. And I'll end with a quote. The former FDIC chairwoman, Sheila Bair, she quit for a reason, by the way. She helped clean up the last bailout, and she probably doesn't want to be around for the next one, but she's now a consultant, of course. This is her exact quote. I created this presentation a couple months ago. September 15th, she was quoted as this: large financial institutions still have way too much leverage. Okay, this is coming from the very top. Okay, this is not some lunatic blogger, fringe, conspiracy theorist with tinfoil hat. This is the established.
Can you repeat that?
Large financial institutions still have way too much leverage. She says a lot more than that, but that pretty much sums up. That sums up where we are today still. And if anybody wants, I have a link to the article. And this article is good because it references a lot of other articles, so you can further expand your research. So that's pretty much it, if you have any questions. All the tomatoes. Sure, go ahead.
So, do you have any good news?
No, but I was a Boy Scout. And what's the motto? We talked about this. I was prepared in 2008. I didn't lose money in 2008.
So how did you prepare?
I can't tell you.
Have a one-to-one.
Because that's what I do.
I can tell you.
What do you,
I can tell you,
don't tell us.
Go ahead.
and silver,
What?
gold and silver. It's the only thing that will be recognized in the
That's
country.
right. Crap, it's.
Like I said, I can't take any more clients in Switzerland. The reason why Switzerland, by the way, is because there's the Alps and there's snow. I mean, even the Nazis stored their gold there,
Yep.
right? They stole it and they parked it there. No one invades a Swiss. You know, every household in Switzerland is required to have this. Does anybody know?
Bomb shelter.
Firearms.
Firearms. Assault rifle.
Every male serves 3 years in the military. Females usually serve 2. No one ever invades a Swiss.
And every household has a machine gun. I've seen that.
Heckler Koch.
I don't want to be political. I'm just telling you facts. So.
I have a comment. I actually have been studying what you just talked for the last 10 years. There's a book that anybody can buy and read it called The Creature from Jekyll Island.
Yes.
It's the whole history of the banking system. So to answer your question, how do you preserve your wealth? I would say if you put your money in any type of investment, I don't care if it's gold, silver, anything.
Tangible.
Anything that is tangible, anything that what people buy and sell, the value can change, and the people can manipulate the economy can change the value, so your money will never be safe. I think the only place where your money is safe is things that you own yourself. So your house, if you have your house